It started like any other weekend in the crypto markets. Bitcoin was steady. Traders were positioning for what looked like another quiet Saturday. The sentiment across social feeds leaned cautiously bullish. But within minutes of US President Donald Trump announcing 100% tariffs on all Chinese imports, everything changed. Order books began to thin. Perpetuals markets started flashing red. And by the time most people realized what was happening, over $19 billion in leverage positions had already vanished. This wasn't just another dip. This was the single largest liquidation event in crypto history. A perfect storm of geopolitical shock, over-leveraged positions, and thin weekend liquidity. Across every exchange from Binance to OKX to Hyperliquid, margin positions unwound faster than risk engines could react. Bitcoin plunged nearly 20% in hours, falling from recent highs down toward $100,000, while altcoins cratered 50 to 90% in minutes. Now, in total, more than 1.6 million traders were liquidated. Roughly 87% of those were long positions. Those are traders betting the market would keep climbing. What made this event so violent was not just the tariffs, but the amount of leverage in play. After months of steady gains and ETF inflows, traders had grown comfortable stacking positions 20, 50, even 100 times larger than their collateral. When prices turned, each liquidation triggered another, a cascade that amplified itself. By the end of the first 24 hours, nearly $660 billion in market value had been erased. And yet, just 4 days later, Bitcoin had climbed back above $113,000. Tokens like BNB even pushed to new all-time highs. The rebound was fast, but the message was clear. Resilience doesn't erase risk. It rewards only those who understand it. To grasp the true scale of what happened in this October 2025, it helps to compare it to the FTX collapse in November 2022, the event that until now defined crypto's darkest chapter. Now, FTX triggered roughly $1.6 billion in liquidations. In contrast, this event most recently unleashed 12 times that amount, 19 to 19.5 billion in a single day, and nearly 20 times the size of the March 2020 COVID crash, if you guys remember that one. It was, by any metric, the most chaotic 24 hours crypto has ever seen. But the differences are even more important than the similarities. FTX was an internal failure, rooted in fraud and mismanagement. Its collapse destroyed trust in centralized exchanges and triggered years of regulatory fallout. October 25, on the other hand, was an external shock, a geopolitical event that tested crypto's structure, not its integrity. The system didn't fail, it simply revealed its weakest participants. The contrast is striking. FTX aftermath stretched for months, freezing withdrawals, bankrupting companies, and crushing sentiment. The October crash, by comparison, resolved within days. No major exchanges went under. Liquidity recovered quickly. The market absorbed the hit, showing a kind of maturity that simply didn't exist 3 years earlier. Now, for new investors, the difference is like comparing a bank failure to a market panic. FTX was fraud. It broke the plumbing of trust. The October crash was fear, a shock that punished overconfidence but left the foundations intact. Both remind us that crypto is not immune to extremes, but that volatility can also create opportunity. For experienced investors, the takeaway is even sharper. FTX dragged on because assets were locked in insolvency. October's crash, by contrast, was a flash event, brutal but brief. Now, those who managed risk and understood leverage ratios had the chance to re-enter positions while prices were still disoriented. In hindsight, it was a masterclass in how to survive and even benefit from a liquidity shock. If Bitcoin was the earthquake, altcoins were the aftershocks. Some collapsed as much as 90% in a matter of minutes. On certain exchanges, prices briefly flashed to near zero, not because the projects failed, but because liquidity vanished faster than automated systems could stabilize. Billions of dollars in altcoin positions were wiped out, roughly $7.5 billion from major assets alone. Now, in total, over $130 billion in market capitalization evaporated during those first few hours. And the reason was structural. Altcoins trade with far thinner liquidity than Bitcoin or Ethereum, which means when sellers rush for the exit, prices have further to fall before finding bids. Combine that with extreme leverage, often 50 or 100 times, the cascade becomes inevitable. Each liquidation drives the next. The timing made it worse. Weekends are historically illiquid with fewer institutional players and lower order book depth. So what might have been a 10% correction on a Tuesday became a chain reaction on a Saturday night. But even here, there are lessons. Many of the same tokens that crashed hardest also rebounded fastest. Some rallied more than 20% within days, showing that panic liquidations can create opportunity for patient traders. Now, for newer investors, altcoins are like small cap stocks. They move faster, both up and down. And that's where excitement lives, but also where wipeouts happen. Focus first on understanding volatility before chasing high beta assets. Now, for seasoned investors, this was a stark reminder of liquidity premiums. In moments of stress, thin markets don't forgive optimism. The wise treat crashes as discounts, not disasters, but only if their capital survives long enough to buy the rebound. When markets move this fast, the strength of an exchange isn't just about speed, it's about survival. And on October 10th, as liquidations surged past $19 billion, some platforms folded under pressure while others set new records for resilience. This was the first real-world stress test of both centralized and decentralized infrastructure in a full-blown market panic. And the results were eye-opening. One name stood out above all: Hyperliquid, a decentralized exchange built specifically for perpetuals. It processed between $10 and $12 billion in liquidations during the crash, more than any other platform, without a single technical failure. It reached a record $30.25 billion in 24-hour trading volume and maintained 100% uptime. Every trade, every liquidation, every movement of collateral was verifiable on-chain in real time. Hyperliquid's performance wasn't a coincidence. Its architecture is designed for transparency and resilience. Instead of relying on hidden back-end systems, it uses public smart contracts, liquidity provider vaults, and automatic order book closures. When volatility spiked, its margin and auto-deleveraging systems absorbed the shock efficiently. No outages, no mispriced orders, and most importantly, no hidden losses. It was proof that decentralized design can outperform centralized speed when it truly matters. On the centralized side, OKX emerged as one of the most stable players. It processed roughly $1 to $2.6 billion in liquidations and handled about 17% of global perpetuals volume, a staggering $545 billion during that 24-hour window. Despite the chaos, OKX reported no outages and no major pricing discrepancies. Its infrastructure was built for high leverage environments and it held up exactly as intended. Meanwhile, decentralized spot and lending protocols like Uniswap and Aave also performed exceptionally well. Uniswap maintained steady liquidity with no order book freezes, while Aave's conservative collateral ratios and automated liquidation logic prevented cascading failures. Even in a black swan event, DeFi's core principles, transparency and automation, proved their value. But not every exchange passed the transparency test. As the dust settled, accusations began to surface about widespread underreporting of liquidations, particularly among centralized exchanges like Binance and Bybit. The controversy was sparked by Hyperliquid co-founder Jeff Yan, who claimed that some centralized exchanges underreported their liquidation totals by as much as 100x, CoinGlass officially recorded $19.16 billion in total liquidations, $16.7 billion in longs, and $2.46 billion in shorts. But analysts now believe the real figure could be much higher, perhaps even double, due to technical rate limits that allowed exchanges to register only one liquidation per second, even when thousands occurred. Now, Binance denied the claims, attributing discrepancies to temporary UI bugs during the high volatility window. But decentralized advocates pushed back, arguing that these gaps revealed a structural flaw, that centralized exchanges operate as opaque systems with unverifiable reporting. The discussion quickly spread across Twitter, with analysts emphasizing how DEXs like Hyperliquid provided full time-stamped liquidation data, while centralized exchanges left traders guessing. Now, so far, there have been no regulatory probes, but industry media, from Bloomberg to Yahoo Finance, have started calling this a trust crisis for centralized exchanges. Traders are migrating to platforms that can prove what they claim. Hyperliquid's success became more than technical. It became philosophical. Now, this debate matters because underreporting distorts the way everyone perceives risk. If true losses were 100 times greater than displayed, it means the market's data layer failed, and traders made decisions in a fog. Risk models, analytics tools, even volatility indexes, all built on incomplete information. That's how complacency grows and how cycles of euphoria and panic repeat. It's also a wake-up call. If crypto is too mature, transparency cannot stop at proof of reserves. It has to include proof of events, verifiable on-chain reporting of what actually happens during extreme conditions. That's the standard that decentralized exchanges are now setting. Every major liquidation event tells two stories, one emotional, one strategic. The October 10th crash revealed just how far apart those stories have become. Now, for retail traders, it was a blur of panic. Screens froze, stop losses failed, and millions watched portfolios evaporate. Over 1.5 million accounts were liquidated, the vast majority holding long positions, leveraged between 10 and 50 times their collateral. Many relied entirely on centralized platforms, assuming risk controls would protect them, but they didn't. Most weren't reckless. They were unprepared. They didn't know how liquidation engines worked, how thin weekend liquidity can be, or how leverage amplifies both risk and emotion. Education could have changed that, and that's exactly why tools like Learning Crypto exist, to help you understand the mechanics before you're tested by them. In a market where volatility is inevitable, knowledge becomes the ultimate form of protection. Institutions told a different story. In the hours before the tariffs were announced, large wallets quietly opened over $1 billion in short positions. When the crash came, they made estimated profits of $160 to $190 million, then used the aftermath to buy the dip. Bitmine, for example, purchased $158 million worth of Ethereum while panic still dominated headlines. Institutions didn't predict the news. They prepared for outcomes. They hedged, kept dry powder, and limited leverage. They built systems designed to respond instead of react. The divide between retail and institutions isn't unfairness, it's asymmetry. One side depends on emotion, the other depends on process. But that gap can be narrowed. Retail traders now have access to the same on-chain data and whale tracking tools that institutions use. With the right discipline, anyone can move from reactive to prepared. This crash highlighted a simple truth. The market punishes unawareness, not participation. Every cycle, volatility transfers wealth from those who guess to those who plan. The goal isn't to eliminate risk, it's to understand it faster than the next person. When the dust settles after a crash of this scale, what remains isn't just numbers, it's knowledge. So the October 10th liquidation wasn't random. It was the predictable result of excess meeting stress. It exposed where speculation had replaced strategy and where transparency still lags behind technology. The first lesson is that calm markets are deceptive. They breed complacency, not safety. Risk doesn't vanish in a bull run. It migrates from obvious to invisible. By the time traders feel comfortable, leverage is already layered beneath the surface, waiting for a catalyst. Preparation means respecting that pattern. The second lesson is that liquidity and optionality are survival tools. The traders who recovered fastest weren't lucky, they were liquid. Holding stable reserves, spreading exposure across centralized and decentralized exchanges, and avoiding leverage made the difference between participation and paralysis. The third is that education compounds. The more you understand the system, the less you're controlled by it. Every trader has to choose between being reactive and being ready. The ones who thrive long-term are the ones who study structure, who know how liquidation cascades work, how funding rates shift under stress, and how narratives can distort data. And finally, this event showed that resilience isn't just technological, it's psychological. The crypto ecosystem handled the storm without structural collapse. The people who didn't were those who mistook optimism for preparedness. Bitcoin's rebound above $113,000 shows that the larger bull market remains alive. But what defines maturity now isn't just price action. It's the community's ability to absorb shocks without losing conviction. So take this event as more than a cautionary tale. It's a mirror. It reflects the behaviors, the assumptions, and systems that still shape this industry, and it offers a choice. Keep trading the same way or evolve with the lessons that the market keeps teaching. You can't control the news, the tariffs, or the new catalyst, but you can control your preparation, your exposure, and your response. If you understand those three things, volatility stops being an enemy and it becomes an opportunity. That's the lesson from October 10th. The market doesn't reward panic, it rewards preparation. If you want to go deeper into how leverage, liquidity, and transparency really shape this space, start learning before the next move begins. You can find resources and guides at learningcrypto.com. It's where education meets self-sovereignty. So with that, I leave you with this. Stay patient, stay prepared, and as always, stay in control of your own keys.